All right, guys. Today we're just going to deal with solving the statement of cash flow. This is the topic. If you look at the start, it says a saving statement of cash flow. Now we're just going to take a look at just how to solve it. We'll just go directly because as for the previous videos, I already explained in the YouTube channel. So it will just be direct here. All right. Usually, when given the question for the statement of cash flows, you would be provided with the income statement as well as the statement of financial position. Of course, it is not a must that you are given the income statement. There are questions that you won't be given that, but I'll just start with that one. All right. So you are told here you're provided with the following financial statement for Briar Limited for the year 20x4. Then you are given the statement of comprehensive income for the year ended 31st December 2024. This is the income statement that I told you you must be provided with. And then we have the statement of financial position. We have statements of financial position at 31st December 20, simply speaking, at 31st December 2024. But usually we prepare a financial statement for 2 years. So this is year 2024, but you also prepare for the previous year. So you have two sets. You have two sets of financial statements, right? For comparability purposes, we usually do that. So as for the income statement, even if you are given two statements, you just have to take that one for the 20x4. All right, now let's go to the question. Our question is here. Here is the question. It says required, prepare the statement of cash flows for the year ended 31st December 20x4 using A, indirect method, and B, direct method. Now, our main focus is on the indirect method. Anyway, what is the difference between direct method and indirect method? Usually, the statement of cash flows would be divided into three activities. That is operating activities, investing activities, as well as financing activities, right? Yeah. So the main difference between indirect method and direct method is on the operating activities. That is the main difference. Let me tell you before proceeding any further, why is that difference there? The main difference is on the operating activities, and on operating activities is usually determined using the income statement figures here. So if you say the indirect method, it means that you cannot start from top to bottom. You start from bottom to top. You start from profit before tax, which is computed using accrual basis because that's the basis for accounting. And then you go upwards up to sales. You make adjustments. So it's a bottom-up approach. Simply speaking, an indirect method is a bottom-up approach. You start from profit before tax. Since this profit before tax was computed using the values above here, you have to make adjustments until you reach to the sales figure, and then you proceed, right? But as for the direct method, you do not need to start from profit before tax. As the name itself suggests, it's a direct method. It's a top-down approach. You do not need to take an accrual profit and starting to make adjustments. You start right away. So you simply come up here, sales. I just need cash from sales. Cost of sales. I just need cash from cost of sales. Everything. As for interest, it's an operating activity, so you could just discard it right away. So I would just like to go directly to the question so as to save our time right now. So here I'm just going to the question. As for the indirect method, first of all, when you are in an exam, you will start like this. These are important items, right? Write the indirect method, you write the name of the company, Briar Limited, then statement of cash flows for the year ended 31st December 2024. Some students disregard these matters, but they are very, very important. You know, statement of financial position, we usually say is at, not for the year ended. So you must say for the year ended or for the year ending 31st December 2024. And then we usually have three categories. Now, for convenience, I'll state them all right now. You will have cash flows from operating activities. This is what you always have to know. And then you will have here cash flows from investing activities. As I said, we usually have three activities. And then lastly, you will have cash flows from financing activities. Usually after obtaining all these cash flows, you sum them all to obtain that net cash flows for the period, and after having the net cash flows for the period, you add it to the cash and the cash equivalent at the start of the period, and then if you sum them, if you sum net cash flows for the period and the cash equivalent at the start of the period, you should arrive at the cash and cash equivalent at the end of the period. So do not worry about this at all. I was just trying to give you a full picture of what you're just going to do. Now, we are starting this one directly now. So as I told you, if you are told to use the indirect method, you start from profit before tax, which is given as 450. Let's just go at the top and ensure whether that is true or not. If you do this, if you follow this, never once will you say that something hasn't balanced. Something doesn't balance when you're not following principles, when you're just claiming the performance. Do not claim the performance. So here we are, profit before tax. As the name suggested, it's an indirect method, meaning that we have to make all adjustments at the top, because seeing this profit before tax, it means that all the values at the top were used to obtain it. So I have to make adjustments for all those above amounts. All right. So here I'm just going to start. Now, I just need to mention something that you do not actually need. Usually, when dealing with operating activities, we have three different items to deal with. First of all, we have items that are non-cash items. For example, depreciation, gain or loss on disposal, etc. But also, we have non-operating items, which are very obvious. Non-operating items could be maybe the interest received or interest expense, something like that. It's obviously not related to operations. And lastly, we usually have working capital changes, but you really do not need to know those. It's just an idea. You do not need to apply those when doing this question. They should come automatically, and I'm just going to show you just that. All right? So if you take a closer look here, what we usually do, if you make an adjustment, for example, interest expense reduces the profit. So to adjust it, I add it back. Now I need to tell you one thing. The most problem students face is they just add something back and they do nothing. They just wait until later. When you deal with one thing, you have to deal with it all the way. What do I mean by dealing with it all the way? For example, I have an interest expense. If you add an interest expense, or maybe it's an income you have deducted it, you have to take it to the control account directly. Do not wait. Never once wait. If you wait, you will forget whether you acted on it or not. So if I'm repeating again, if you add back something or deduct it, you have to take it to the control account. That's the main point. Now, as for our case here, for example, if you have faced something on working capital, on cash flows, usually you won't find that you have deducted sales. Sales increase profit, you won't find that you have deducted them. Or cost of sales reduce the profit, you won't find that you have added them. Why? Because we got two choices. As for sales and cost of sales, it's not necessary to add them back or to deduct them. As I told you, if you add them back, you have to take them to the control account and get something there. But as for the working capital, which working capital is usually obtained on sales, on cost of sales, and on operating expenses, as we will see later, you do not need that. You just go directly to the statement of financial position and make a movement. If you have ever had increase in asset, increase maybe in inventory or decrease in inventory, increase in receivables or decrease, increase in trade payables or decrease, that's what you would find. Now, today, I just want you to find out everything on how we do that. All right, let's proceed. I just started with profit before tax, so I would have to make adjustments. How do I make that? Just look at the top. You just copy at the top. It's very, very simple. I just find here interest expense, right? Now you ask yourself, this interest expense actually reduced the profit, so I have to add it back. So just like that. So if you come to the solution, you will find out that the adjustment that I made were here, interest expense. Do not think about saying, oh, non-cash items, oh, non-operating items, oh, changing working capital. This is none of your business at all. You do not need to write this. No one needs this one. All right. So expense here, which is 100, like you see it here. I've added it back. Now, as I told you, after adding it back, do not relax. Do not say that everything is finished. Take it to the control account. And control accounts are usually found on the statement of financial position. So you should come to the statement of financial position and find the control account. If you come here, reduce it under current liabilities, because if you are paying interest, it's probably a liability in the statement of financial position. You would find something here, interest payable. We opened with 30 and we closed with 50. So that's a control account. You go and open it directly. Do not wait. I'm repeating again, do not wait. So just go and prepare this control account for interest payable. All right. So I'm just starting my workings here. Working one, I've just written interest payable control account. As you saw, this is a liability. So it would have an opening balance on the credit side that is 30. We just copy there from the books. And it would have a balance closed balance CD of 50. Now, as I told you, as for that 100 that I added back, it usually has to be taken to the control account directly. Do not wait. Never ever wait for that. All right? So the interest expense, an expense is of a debit nature in the income statement. So if you bring it here, it will come to credit. So that's why I have written here interest expense and I have written 100. I could simply have written statement of profit or loss and then I write here 100. Now, if you are in an exam, you do not need to close this account because there are some situations I find out complicated question that you might find that there is another entry that needs to be inserted here. But for our case here, it was just easy. So I could close this account right away. Now, how do I close the account? Usually take the total. 30 plus 100 equals to 130. If you compare to here, the balance was 50. So usually take the high amount. So 130 here and here 130. After that, I would have a balance of what? 50 plus 80, I would get 130. So interest paid would be a balance of 80. Now, what do I mean by interest paid? This is the cash. This is the cash equivalent of that interest expense. So in reality, I incurred an expense of 100, but the interest actually paid was just 80. So this is what is a cash flow now. Now, all you need to know is where should I deduct this interest paid? Now, you pay interest because you have been financed. So I could put it under financing activities, but it's a normal practice to put it under operating activities, but strictly not under operating activities really. Just take a look here. We usually do this under operating activities. You make your adjustment, as I told you, from profit before tax up to the sales figure, and the value that you obtain is usually called cash inflows or outflows from operating activities. So you determine that figure first, and then that interest paid is being taken down of it. Interest paid working one, that is 80. Now I hope you have seen this. That's why in some situations, for example, presume that you came to the statement of financial position and you didn't find this interest payable control account. This simply means that opening balance was 0 and the closing balance was 0. So there was no need to show that line item for interest payable. So automatically it would mean that if the interest expense was 100, I would have paid the same interest of 100 again. Now, do not say, oh, why did I adjust them since they are the same 100? No, we need information. Adding here 100 and subtracting 100 here actually would bring the same result of 930 here, but it would give different information. We really need these cash flows from operating activity. We really need it. We really need to know what would have happened if I hadn't paid for interest. So you really might need to know that. I hope you have got that. Now you can proceed. It's very easy. And as you have seen now, you would have income statement, statement of financial position, as well as additional information. Now these matters are usually done one after another. As you see, we are in the income statement, but we have already started acting on the financial position. Now, we just proceed this way. We said profit before tax will go up to the sales. Now I'm done with interest expense. If you go up, you find what? You find distribution cost. Now it's my choice. I have distribution cost here. Distribution cost, that is 2,400. Now, as I told you, when speaking, we have non-operating items. Distribution cost is also not a non-operating item. Is obviously it is obviously an operating item. I mean, an operating expense. So, as I told you before, as for working capital changes, we deal with items related to sales, related to cost of sales, and related to operating expenses, which here would be administrative expenses and the distribution cost, right? So if you find the word distribution cost or administrative expenses, this is part of our working capital. But we know that working capital equals to current assets minus current liabilities. And assets and the liabilities are not found in the income statement. Rather, they are found on the statement of financial position. So if you just find the word here, distribution cost, you do not need to ask yourself, oh, let me add it back because it decreased profit and take it to the control account. And for the indirect method, you do not need to do that. All you need to do is you just have to go to the statement of financial position and there's a spot the current asset or liability related to this distribution cost and make a movement, an increase or decrease. If you do that there, you are done with distribution cost. So I highlight it here and go to the statement of financial position to find on whether I have distribution costs. You know, these operating expenses could have been prepaid or could have been accrued. So you could find them on prepaid expenses or on accrued what expenses. So let's go and find out. Just come here on current assets, there is prepaid administration expenses. I don't need it. And if you come down here on liabilities, you would find the term accrued distribution cost. I hope you see this. This is simply a current liability. So you find out that I opened with 35 and I closed with 10. So there has been a decrease in current liabilities. So you just come to the statement of cash flows and say here, as you see, decrease in accrued distribution cost from 35 to 10, with the difference is 25. Now see, that 25 has been placed as negative. Why did I place it as negative? Why? Any liability, presume that you had a liability, like a liability decreased and there was no any other reason other than cash. If a liability decreased and there was no other reason than cash, it's obviously I gave out cash, right? That's why the liability decreased. And that's why when doing this, you have to make sure that you have read all other instructions such that all is left is cash. So this is B25. So any liability decrease would have to be negative. Any liability increase will be an increase. While for assets, any decrease in assets will be a positive cash flow, and any increase in assets will be a negative variable at the core. So I'm done with the administration cost. So let me tell you one thing. What if you came to the statement of financial position and you didn't find this accrued distribution cost? Do not worry, just presume that we opened with 0 and we closed with 0, so the difference is 0. So do not come and hustle and ask yourself, oh, now what should I do about this 2,400? Just leave it alone. Just leave it alone. Why do I say just leave it alone? I mean leave it alone because even if you use the principles different to increase or decrease, maybe I said, oh, I add it back and take it to the control account. If you added back 2,400 and took it to the control account, you would find yourself that you have to deduct the same 2,400 and they stay on the same amount. And so it will be nil. So you really need to know what you are doing right here. It's not just about following performance. Now I just continue going up. I said go up until you meet sales. If you go up here, you find administration expenses, that is 600, right? Now, yeah, this also is an operating expense. So there could be a prepayment or an accrual. So just go to the statement of financial position to spot it. Now, as you remember, we spotted it here under current assets. We said prepaid administration expenses. It started from 40 and ended up with 20. You really need to know it started from where, right? From the question you are told this was 20x3, this 20x4. So it started from 40 to 20. So you find out that there is a decrease in prepaid administration expenses. This is an asset, right? The prepayment is an asset. So an asset has decreased from 40 to 20. So here I am. Here, as you see, decrease in prepaid administration expenses. from 40 to 20, and the difference is 20. Now see, there is a decrease. We have taken it as a positive, and this is an asset. Ask yourself, just ask yourself, you had an asset, that asset decreased, but there's no any other reason other than cash. It means I gave it out, I sold it, and I obtained cash. That's why I put this as positive, right? In case there was an increase, you ask yourself, I had nothing, and now I had an asset, and I had an asset. How did I obtain that asset? I paid. I gave out the money, and it should have been negative. So this is how we go. And now you proceed as I told you. You just find out that you will be eating the item to the income statement. While eating item to the income statement, you will also be eating item in the statement of financial position. So until you complete the income statement, you have done a lot, and you will be very, very accurate. So I proceed. Up here is the interest received. Did you see interest received? Now looking at this figure, it has stayed like it's a cash item. When interest received, that means I've received cash, but not worry about that. Whether it is there has been written as interest income or interest received is none of your business. As long as you find it in the income statement, we believe that this is the accrual basis has been used here. It might have been written interest income. All we know is the interest that we have earned, not necessarily received. So interest received is 50, it increased the profit. So I just need to deduct it. It increased the profit, I deduct it, right? I told you, if you add something or deduct it, you must take it to the control account, right? So I have interest received here. But for working capital, there is no need. You can just make a movement as we saw for administration expenses and distribution costs here. So I'm just go to the statement of cash flows and operating activities section and deduct that 50. So our statement, where was it? Yeah, here it is. Now see investment income. It was interest income. Well, yes, interest income. 50, I've deducted it. As I told you, after deducting it, you really need to go to the statement, to the control account, and prepare that. Now, sometimes it's not a must. If you take a look, for example, to know the control account, you need to come to the statement of financial position. So if I was supposed to receive interest and I'm yet to receive them, you would have found them under current assets here. You would have had, let's say, interest receivable, right? There will be something interest received, but I don't see it. I just have inventory, trade receivables, cash, and these other investments. So since I do not find it, it means that even if I prepared a control account, just as for interest, let me show you here. I think you see interest payable. If it was interest receivable, that means opening balance was 0 on the debit and the closing balance was also 0. So even if I placed it in here, I would have come up with the same interest income of how much? Of that same figure of 50. So I do not need to prepare a control account because I'm 100% sure that that's what I'm just going to obtain even if I prepare a control account. So you just ask yourself, where did that interest received go? It usually comes to investment activities. That's why you see it here. Interest received, 50 is a cash inflow, just like this. You proceed this way until you complete everything. So we are back to the income statement. I think you see the way we move, right? All right. Come to the income statement.
Yes.
Yeah. We have gross profit. Now, dealing with gross profit, actually, you do not need to deal with it much because it is just the difference between sales and the cost of sales. So just go and take a look at the cost of sales figure and come to the sales figure and complete everything. Now, as per convention, from what I stated, I said that if you have something that reduces the profit, add it back and take it to the control account. But I gave you a simple approach to the working capital figures. I told you that something related to sales, cost of sales, and operating expenses, there is no need to add it back and take it to the control account. You just ascertain the assets and the liabilities on the financial statements relating to these line items, and you just make a movement. That is, you kill two birds by one stone. That's what I'm just trying to do when it comes to items related to working capital. They are not working capital themselves, but they relate to working capital because working capital involves current assets and liabilities that are in the statement of financial position. So, if you take a look at cost of sales figure, you do not ask yourself a lot. You just say, oh, this is cost of sales. How to obtain cost of sales? is opening inventory plus purchases minus closing inventory. Clearly, we have mentioned opening inventory and the closing inventory. So if you make a movement to the statement of financial position for inventory, you have partly dealt with cost of sales. Then we add purchases. How would purchases be reflected in the statement of financial position? If you make a purchase, you probably would have paid something that is cash, and you don't deal with cash now. Cash is dealt with in cash and cash equivalent. But if you haven't paid, you would have a trade payable. So, speaking, when you see the cost of sales, it is obviously related to the two items in the statement of financial position, which are inventory and trade payables. Just make a movement of inventory and trade payables, you would have dealt with cost of sales. You won't see it, but that's what it really is. All right, and if you come to sales now, sales figure, sales, I could have sold something for cash. I would have cash in the financial position. Cash is very simple, you don't need to deal with it. You just deal with it finally. But if I sold on credit, I would have trade receivables. So in the statement of financial position, if you deal with trade receivables, everything will be done. So simply speaking, you just go to the statement of financial position, you deal with trade payables, inventory, and trade receivables, and everything will be fine. So here I am, trade payables on the current liabilities figure. You move from 300 to 325. So there has been an increase in trade payables. So here I am, increase in trade payables, yeah? Increase in trade payables from 300 to 325, and there has been an increase of 25. As I told you, whenever a liability increases, just put a cash inflow. If there is no any other reason other than cash, to know whether there is a reason or not, we usually have a control account, but here we said no need. So if a liability has increased, it means that I have received more. And the reason is cash, I've received cash, but actually I haven't done anything, right? So I have just increased cash of 25, so I'll put it as positive. And then we go to, we said inventory and what? And the trade receivables, those are assets. So I just go to current assets here. I find my trade receivables figure. As you see here, trade receivables, it has increased from 180 to 150, an increase, it was decreased, sorry, a decrease by 30. And for inventory here, it has decreased from 480 to 380, a decrease by 100. So you simply go to the statement of cash flows and plug in that. Very, very simple. So I would say a decrease in trade receivables by 30, as I told you, if an asset decreases, you go the reverse. An asset has decreased, I say I have a cash inflow. Because if I have an asset, and the main reason is whether I've given out cash or I've received the cash, and the asset has decreased, that means I've given out my asset for cash, so it's a cash inflow. So I would say the same for decrease in inventory, right? That will be 100, 480 minus 380, just like this. So up to here, you can proceed. As I told you, you just go back to your statement. You know, in an exam, you need to know how to trim the scope of the question. If you find out up to here, you say that, oh, even if I need to go to another question, I could go, but all I know is I've already dealt with from profit before tax to sales. So even if I go to another question and I need to come back, I'll just proceed from here. All right? So you just come down here. Now, not one thing, you know, there are usually things like depreciation and what, but I did not see it here. But usually, if you do not see things like depreciation or gain on disposal, they definitely would be either the cost of sales, admin expense, or distribution cost. So no problem. You do not need to read that in the notes, because if you find depreciation is in admin expenses, it just shows us, oh, so depreciation, I did not see it here, but it was also used to obtain profit before tax. So I also adjust it. Very, very simple. So let's just finish up with the income statement, right? So I come to my income statement here. After profit before tax, now down it, we find the word income tax expense. And now a thing here becomes much, much easier. Why would I say it becomes much, much easier? I have an income tax expense of 30. Right now, before we said that you add back something or you deduct it and you take it to the control account. Because they were above profit before tax, we needed to adjust them. But right now, they are below profit before tax. They were not used to obtain profit before tax. So I just take them directly to the control account. It is difficult, guys. It's very direct because they are not used to obtain profit before tax. Just take them directly to their control account. So I would prepare a control account for tax. So I would prepare a tax control account. How do I prepare a tax control account? You ask yourself, income tax expense was 30. You just come and prepare a tax control account. Now let's find it. You can just prepare it the way you wish. That's why there is a different method here, right? So I would say tax paid, not necessarily working 6. You could have done it in any working, just the way you feel. So I could say here taxation control account. Now, as I told you, the tax expense in the income statement is of a debit nature. So if we bring it to the tax control account, it will come to the credit. So that's why I wrote tax expense and I mentioned that figure 80, right? I just listed that figure 8. It was 8, right? Let's check it. Let's check it and be sure. Was it really 8 or what? Yes, here it is 8. After doing that, I've prepared the taxation control account. That means I need to go to the statement of financial position and find all tax assets and liabilities. And now, as for the tax issues, you really need to inspect all assets, both current and non-current, and all liabilities, both current and non-current. Do not find one line item and say, oh, I'm done. No. In tax, we have current tax and deferred tax as per IAS 12. So deferred taxes can also be non-current assets or non-current liabilities. So you have to inspect everywhere. As for non-current assets, I see nothing in tax. As for current assets, I also see nothing in tax. Let's go to liabilities. If you go to liabilities, as for non-current liabilities here, you find you have deferred tax. So I opened with a deferred tax liability of 70 and closed with 100. And as for current liabilities, I opened with a deferred tax with a current tax liability of 15 and closed with 25. So that's what I'm just going to copy there. So 70 to 15 and 100 to 25. 70 to 15, 100 to 25. These were liabilities of a debit of a credit nature. So opening balance of current tax would be 15, while deferred tax would be 70. While the closing balance, this balance CD is here, we say that we have 25 for current and 100 for deferred. So if there is nothing, if you do this, you do not necessarily have to close this account, but for our case, this was over, so I just close it. So if you close this account, you find out that you have a total of 165 here, which is greater than this one, 25 plus 100, which is 125. So 165 minus the total of 125, you have 40, and this would be the tax paid. Now, let me tell you one thing. Whenever you have a cash balance on the debit side, we say that cash has been paid because this is actually not the cash account. This is the tax account. So if the tax account has been debited, it means that the cash account has actually been credited, so cash has been paid. So any cash balance on the debit side of the account would amount to a cash payment, right? So tax paid, where does it stay? In the statement of cash flows. We usually take it here. Down the interest paid, you take the tax paid here, working 6, we said, and you say that you have your 40. Then you proceed, all right? So this is what you need to do. So going back to our income statement, as we said, down here now we got the profit for the year. Now, as for the profit for the year, we usually know where it goes. After determining on the income statement, after having profit for the year, we usually take it to the retained earnings, right? It goes to the statement of financial position and the retained earnings. So I take it directly to retained earnings. This prompts you to open the retained earnings control account, right? So that's what is going to follow right now.